Have you ever felt like the stock market is stacked against you? Like no matter how much research you do, the big players always seem to win. You're not alone. Many believe the stock market is rigged in favor of hedge funds, institutions, and insiders who know the game better than the average investor. But is it really true? And if so, what can you do to level the playing field? In this video, we'll uncover what experts don't want you to know about market manipulation, hidden strategies, and how you can protect your investments. Today, we will talk about, is the stock market rigged? What the experts don't want you to know. So before we get started, make sure to hit that like button, also subscribe to my channel. The stock market has always been a place where fortunes are made and lost. It's a game of numbers, strategy, and sometimes pure luck. But what if the game isn't fair? What if the system is designed in a way that benefits a select few, while the average investor is left to struggle? Many people believe that the stock market is rigged, and they might not be wrong. In this video, we're going to uncover the hidden truths about the market that experts and big players don't want you to know. The illusion of a free market. The stock market is often described as a free and open market, where anyone can invest and succeed. In reality, the playing field is far from level. While everyday investors rely on public information and traditional strategies, hedge funds, institutional investors, and high-frequency trading firms have access to resources and advantages that regular people can only dream of. From insider knowledge to algorithmic trading, these entities hold a significant edge over the average investor, making it nearly impossible for most people to compete on equal terms. High-frequency trading, the unfair advantage. One of the biggest factors contributing to the belief that the stock market is rigged is high-frequency trading, HFT. HFT firms use powerful computers and advanced algorithms to execute trades in milliseconds, far faster than any human could react. These firms exploit microsecond price differences and make profits before regular investors even have a chance to place their trades. This means that while you're trying to buy or sell stocks based on market trends, these algorithms are manipulating prices and taking profits ahead of you. The worst part, this is all completely legal. Insider trading and market manipulation. While insider trading is illegal, it still happens more often than we realize. Powerful individuals and financial institutions often have access to critical information before the public does, allowing them to make trades based on knowledge that the average investor doesn't have. This creates a major disadvantage for retail investors, who are always a step behind in the game. Market manipulation is another concern. Large institutions, known as market makers, have the ability to influence stock prices by executing massive trades. By creating artificial demand or dumping stocks in bulk, they can manipulate prices to their advantage. Meanwhile, small investors are left reacting to these price swings without understanding the real reason behind them. The role of the Federal Reserve and government influence. The Federal Reserve plays a crucial role in the stock market, and its policies often benefit big investors while leaving small investors vulnerable. When the Fed pumps money into the economy through quantitative easing or lowers interest rates, stock prices tend to rise. While this seems beneficial, the real winners are large corporations and institutional investors who can take advantage of these moves before regular investors even understand what's happening. Similarly, government bailouts have historically favored big banks and corporations. During financial crises, large institutions often receive financial assistance, while everyday people are left to deal with job losses, home foreclosures, and economic uncertainty. This creates a market where risks are socialized, but profits remain privatized, meaning that when things go wrong, taxpayers foot the bill, but when things go well, the wealthiest players reap the rewards. Pump and dump schemes, the dangers of hype investing. Social media and online investing communities have given rise to a new form of market manipulation, pump and dump schemes. These schemes involve artificially inflating the price of a stock by generating hype, only for early investors to sell off their shares at the peak, leaving others with massive losses. We've seen this happen with penny stocks, cryptocurrency, and even some major stocks driven by social media trends. The problem is that many new investors fall for these schemes, thinking they've discovered a golden opportunity, only to end up losing their money to more experienced manipulators. The reality of short selling and naked shorting. Short selling is when investors bet against a stock, hoping its price will go down. While short selling is a legitimate strategy, it's often used by hedge funds and institutional investors to manipulate markets. Naked short selling, which involves selling shares that don't actually exist, is another major issue. Although technically illegal, loopholes in regulations allow it to happen, leading to massive price declines that hurt retail investors. When hedge funds target certain stocks with these strategies, they can drive down prices and force investors to panic sell, creating huge profits for themselves at the expense of everyone else. The GameStop saga, a rare victory for retail investors. One of the most famous examples of retail investors fighting back against Wall Street was the GameStop short squeeze in 2021. A group of retail investors on Reddit identified that hedge funds were over-leveraged in shorting GameStop stock. By collectively buying shares and refusing to sell, they caused the stock price to skyrocket, forcing hedge funds to cover their short positions at massive losses. While this seemed like a victory for everyday investors, the aftermath revealed just how rigged the system can be. Trading platforms like Robinhood suddenly restricted trading on GameStop and other similar stocks, preventing investors from buying while hedge funds were allowed to exit their positions. This raised serious questions about whether the market is truly fair or if powerful players have the ability to change the rules when things don't go their way. The role of financial media in stock market manipulation. Many people don't realize that financial news outlets play a huge role in market movements. Large investors and hedge funds often use media to their advantage, releasing news or making predictions that influence stock prices. When a well-known analyst downgrades a stock, its price usually drops. But is that rating based on genuine analysis, or is it part of a coordinated effort to drive prices down for a better entry point? Similarly, when positive news about a stock is overhyped, it can create a buying frenzy that benefits those who got in early while leaving latecomers with overpriced shares. While it's clear that the stock market isn't as fair as it's made out to be, that doesn't mean success is impossible. By understanding the advantages that big players have in learning how to navigate the market wisely, you can still build wealth and achieve financial success. The key is to stay informed, think critically, and make investment decisions based on logic rather than hype. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.